Good afternoon, investors and traders, and welcome to the latest edition of Finom Group's weekly State of the Market. I'm Seth Golden, and I'll be walking you through some of our latest charts, analysis, and general thoughts during this March to 4,000 in the S&P 500, which seems to be coming rather quick here in the new year. Keep in mind, everyone's calling the top. And if it's not a top, all the strategists and analysts are saying there has to be a 10 to 15% correction by the middle of this year. Just seems to be something that they do rather frequently when price has gotten, well, ahead of their understanding. I guess that's the best way to put it. They don't understand the price action. We have this relentless, rally and continued momentum to the upside. So we've got to get, some type of garden variety correction. If not, a correction on the magnitude of 15%. These same strategists and analysts that are, issuing these types of corrective calls are the same strategists and analysts that will tell you when everybody's leaning toward one side of the boat, it's best to be on the other side. So just think about that for a second. There's like 23, I've counted it, 23 analysts or strategists, fund managers that have come out on CNBC or Bloomberg over the last 32 days, yes, I've got the data logged, that have called for a 10 to 15% correction. To me, it sounds like everybody is on that side of the boat. Go figure. Yeah, that we haven't had, much more than a few percentage points in the way of consolidation here in the new year. All right, well, let's get things started. Let's get this party started, folks. Okay. Markets change minute by minute, right? We all kind of know that, but human nature changes barely millennium by millennium. Knowing that, that's your edge, folks. History tends to repeat, if not rhyme. And that's from Jim O'Shaughnessy. Right now, selling May, that's a couple months away, but the point of showing you this chart right here is this shows you the best periods for the market during the course of a year. In 2020, like 7 of the past 8 years produced a positive gain in the 6-month sell period. The sell period is typically understood to be May through October. So you sell here in May, you come back, or you sell here in May through October. The average percent change on the S&P 500 is just 1.5%, but the market is higher 64% of the time. This goes back to 1950, folks. The November to April period is the best time to own stocks with a strong positive performance rate of nearly 80%. Here it is, November to April. The average gain over that 6-month period, 7%. Not too shabby. The percent positivity rate, though, is nearly 80%, and it's higher than any other 6-month period. And we're still in that period, folks. We still have the back half of February, March, and all of April. We still have basically 2.5 months left in the 6 best months, best month period to own stocks. And so while everybody's calling for some type of a top or some type of corrective wave in the market, by the way, that is normal and to be expected. Don't fear downturns, use them as opportunity. This chart right here from JP Morgan, S&P 500 intra-year declines versus the calendar year returns. The average intra-year drop dating all the way back to 1980 is 14.3%. It used to be 13.8%, but when you get an outsized drop like we did last year of 34%, you're going, it's going to skew the data higher. So it went from 13.8% now to 14.3%. The point is, expect some type of consolidation. We don't know what degree consolidation we're going to have. We just know that at some point, price will consolidate. There are periods in time, though, that you don't get any significant correction. 8%, 7%, 8%. 4 years here where we did not get a 10% pullback. 2 years here in a row, we did not get a 10% pullback. So, and then look back here at the 90s. Look at the 1990s, folks. Oh my good gosh. 7%, well, 6%, 6%, 5%, 9%, 3%, 8%. That's 1, 2, 3, 4, 5, 6, 7 years in a row. The market did not decline by double digits. 7 years in a row. The market did not decline by double digits. The longest the stock market has gone without a double-digit correction since 1950 was 7 years, from 1990 to 1997. So, while this is an average, the average inter-year drop is 14.3%. That doesn't mean every year you have to have a 14.3% drop. Recall 2017 right here, folks. 2017, the biggest drop was 3%. So just because we haven't had a material correction here so far in 2020 doesn't mean we have to have one based on the historic data. One of the most helpful things that anybody can learn is to give up trying to catch the last eighth, right? The last eighth at the top, the last eighth, at the bottom of a move. These two are the most expensive eighths in the world. That quote by Jesse Livermore. And speaking of tops, we've talked about in the past how buying at the tops, while people tend to have this belief that buying the tops is just begging, of a drawdown in your portfolio. Again, who cares? Who doesn't take a drawdown in their portfolio? But in general, when you look at the performance after new all-time highs, 1 month, the market is still higher on average. 3-month return, again, the market's still higher on average. Again, this data goes all the way back to 1950. 6 months later, the market is up some 4%. 12 months later, the market is up some 8%. Don't be afraid of buying tops. Just stick to your game plan, your strategy, and have a tactical approach to the stocks that you do want to buy. Don't think so near term. The market consolidates. History tells us, as we've been hitting new highs, that price consolidation is just opportunity a month later, 3 months later, 6 months later, and 12 months later. Don't be afraid of tops. This chart right here, speaking of 4,000, right? 4,000 seems to be just within arm's reach of the S&P 500. How does the market tend to perform around these major, milestones? Well, this is the S&P 500 when it was attempting to get to 1,000. Looks like back here in the early mid 1990s, and it struggled. As you can see, the upper square line here is 1,000, and it struggled. And it had a 13% correction, and it chopped around a lot going into what looks like, let me see, what year exactly is this? 1998. Chopped around a lot going into 1998. So you're talking about a good 6 months worth of chopping before it finally got above 1,000. But when it did, what a monstrous rally, folks. Point here, chopped around, struggled to get to 1,000, but when it did, really took off. Here's 2,000, S&P 500 trying to get above 2,000 back in 2014, basically mid-2014. It had a dip before. It had a dip of about 6%. And then recovered in September, got to 2,000, but then it corrected another 8.5% basically before, again, off to the races. And for a while, 2015 into 2016. S&P 500, the attempt at 3,000. That came, again, it looks like mid 2019, got to 2000 here. I'm sorry, 3000, and then we corrected. And that's a good 6% correction, chopped around, got back above 3000, had another bout of corrective action here, and in, well, 2020, off to the races in the fourth quarter into 2020, January, February, and then we all know what happened here. COVID. Recovered from COVID, and we're getting very close here. New all-time high set this week, 3950 on the SP 500, folks. So the reality is, though, when you look at all the new highs that when we get above these mile markers, these round numbers, the 10-day forward returns are pretty crappy. You got a negative 0.05%. And they got all of them here, folks. All of them in the 1000s, in the 2000s, and then in the 3000s. The 10-day forward return around these whole number achievements, the 10-day forward returns are basically negligible. Market likes to consolidate. For whatever reason, human behavior says that achieving that milestone marker is meaningful. And people are looking for the next catalyst. What's the next catalyst? To buy stocks, to keep pushing higher. This chart right here, looking at some of the breadth metrics within the S&P 500. These are the industry groups. And right now, as we started this week, 58% of industry groups were trading at 52-week highs. That is some very strong breadth, folks. Fewer than 30% of large cap groups made new highs, though. So this was a lot of small and mid cap groups that have been leading this market higher here in 2021. It hasn't been the large caps, and you probably felt that in those names like Procter & Gamble, Apple, Facebook. A lot of those just mega cap names, Microsoft, just haven't done much. Boeing, McDonald's, Disney. This has just not been a large cap friendly year thus far. And that may be something that, finds this market to come under pressure in the near term if the mid cap and small caps can't keep this momentum going. Breadth. Again, S&P 500, looking actually at the S&P 500 and the NASDAQ plus the NYSE new highs. And you can see, folks, breadth has just been awesome. The NYSE and NASDAQ registered the greatest number of new highs in history. Again, just chalk this up to yet another record-breaking breadth reading, folks. And kind of looking under the hood at the S&P 500 as well as the NYSE trend of new highs. As you can see in January, we weren't able to sustain, the size, the number of new highs week after week after week until we finally were basically bottoming out with, very few stocks making new highs. But as we entered into February, off to the races again. Off to the races. We're making a lot more new highs here. Expansion in new highs for both the S&P and the NYSE is a key piece of the bullish argument. An evaporation in new highs would be a key sign of exhaustion. And that's, I think, what happened in January. Market just became exhausted. And we started to, come under pressure as earnings season started. But then as we started to, see the strength in earnings, the beats, we started to see the market pick up again and new highs started to proliferate. Breadth leads price. Keep that in mind. Breadth leads price. Possibly more importantly, this is not how tops are made, folks. Tops are not made with good breadth. Tops are made on weakening breadth for many weeks, if not months. Russell 2000. Now, this chart comes to us from Carter Braxton Worth. You probably see him many a time on CNBC. He's the chief technical analyst at Cornerstone Macro Research. And looking at this chart right here, the Russell 2000 is too hot right now. It's overdone. It's overbought. It's overloved, with mean reversion being highly likely at this point. That's Carter Worth. That's how he feels about it based on this chart right here. The percentage index is trading above the 100-day moving average. This is nothing this index has ever seen before. This is a record. This is a record for the Russell 2000 above its 150-day moving average. So in Carter Worth's opinion, overbought, overdone, overloved, and in dire need of mean reversion, if I can paraphrase. So what does he say you should do? Trim. Sell calls if one is long. Sell short if one is a short seller. Short the IWM, go long the SPY if one is a pairs trader. So those are three options Carter Worth puts before the investors. Now, I'm not a big fan. I've seen him be wrong so many times, it's almost grotesque. However, with respect to what we have seen in the Russell, what I would say is unprecedented characteristics of the trend in the Russell does beg for some degree of caution and maybe some profit taking. If you're in small caps, if you're in the IWM, which is the small cap Russell ETF, take some profits, lock them in, rotate that money to other areas of the market possibly. Markets don't go up in a straight line, bottom line. All right, we've done the Russell, we've done the SP 500. Here's another breadth chart. And this kind of goes back to something we touched on last week when we looked at the NASDAQ 100. And we saw that the NASDAQ 100 had weakening breadth, while the NASDAQ itself continue to move higher. Here's the triple Qs, and as you can see, we've got kind of a breadth divergence here. Going back to basically the new year, breadth topped out, but the Qs kept moving higher, and breadth has continued to weaken. Got to its low point here and has since bounced, but we still aren't getting back to the levels we were before. And the Qs are only a fraction off of their high. So this is, the breadth divergence that we talked about last week in looking at the NASDAQ 100 stocks above their 50-day moving average. We saw the highs back here to basically end the year, and this bearish breadth divergence developed, even as price continued higher. Now, breadth divergences happen all the time. You're not going to sustain this characterization in perpetuity. You're going to have some stocks that are going to fall back. They're going to consolidate. People take profits and they move elsewhere. So that's why the absolute level of the breadth reading is more important than the actual breadth divergence, because divergences do happen literally all the time. The absolute level is right around 67 here. That's still a good level. What you want to look out for is if it breaks below 50, because that tells us that less than half of stocks are trading above their 50-day moving average in the NASDAQ. That's something you would probably want to pay attention to. All right, last week we also talked about the consumer staples. Consumer staples being the worst performing sector of the market in 2021. This chart, however, this chart above identifies the 362-week cycles dating all the way back to 1989. And as you can see, when we go from 360-week cycle to the next, you get these dips and rips. Dips within and a rip. We're at this support trend line here. It's happened in the past too. Dipped all the way down, came all the way up. Dipped all the way down, came all the way back up, and a dip all the way down again as part of this 362-week cycle. And now we're basically at trendline support. Can the staples consolidate here and start to find accumulation and at least get back to some semblance of market performance? Maybe other areas in the market are going to fall back, and some of the defensive sectors like staples, like utilities, are going to pick up the pace. We are in a bull market. In a bull market, we see a lot of sector rotation being the lifeblood of a bull market. So far this year, it's been about small caps. It's been about mid caps. It's been about consumer discretionary. It's been about energy, right? Crude oil. It's been about the cyclicals. It's been about the banks, the financials. But at some point, investors take profits. They know they're in a bull market. They don't want to be out of the bull market. They still want exposure. So they look for where they can find value. Where can they find value right now? Well, the defensive sectors, the utilities, the REITs, the staples. So we'll see. We'll keep an eye on the staples and see if they can get a bounce. I tell you what, though, Walmart's results, their earning results that came out this morning, not going to help the consumer staples sector ETF. So that's going to be a little bit of a drag. It's going to be, and don't get me wrong, Walmart's earnings were pretty darn good. And we can get into that another day. They missed on the bottom line. Part of that miss was due to a UK tax that they had to pay, which was about 7 cents a share of the 12-cent miss of estimates. And the other portion was, oh my gosh, did you see their revenue beat of $5 billion? They beat revenue estimates by $5 billion. They slaughtered same-store sales. A lot of that has to do with the level of e-commerce growth that they're seeing. The e-commerce channel doesn't deliver the same profit margins as do the physical brick and mortar sales. So they beat revenue estimates by, imagine beating revenue estimates if you're Intel, if you're Disney, by $5 billion and your stock gets slaughtered by like 5% on that sales beat, because it impacts your earnings based on where those sales are coming from. I'm of the opinion this is a buy the dip opportunity for patient investors, but we can go into that another day. All right, so it's not just the US, folks. It's not just the Dow. It's not the NASDAQ. It's not the Russell. It's not just the SP 500 making new highs. The global Dow has also made new highs. We've been keeping an eye on the global Dow once it broke above this key resistance level, and it's just kept going. We've had some consolidation along the way, but this week it made new highs. The global Dow chart above continues to produce higher highs. Again, this is not how tops are made. Valuations, right? Yeah, valuations. Everybody's talking. That's why we have to correct, and earnings will take some time to catch up. So the market has to correct. We're way overvalued. Everybody's screaming about the Warren Buffett indicator, or his main value indicator, which is the Wilshire 5000 index, correlated to the gross domestic product in the US. And as we can see, this is a really crappy indicator. First of all, it has no practical use. You only know in hindsight whether or not you're going to see a correction based on this, or you're not. This has been making the rounds a lot lately, but it isn't very helpful from a practical standpoint. It's fraught with hindsight bias, and when adjusted to account for such bias, it proves way too early, thus wrong. Folks, we've been at these levels here higher than in the 1990s in the dot-com bubble for the last 3 years. And yet we are still making higher highs in the S&P 500. So in other words, are you really telling me we've been overvalued for the last 3 years? Now, a lot of pundits will say yes. Yeah, you don't have to like it, but yeah. And that's why we had this major, look, we didn't have a major correction because of the Warren Buffett indicator. We had a major correction because of COVID crisis. Stop it. So again, this is just a terrible real-time tool if you're thinking about, the market being overvalued. You could have said that in 2018. You could have said it in 2019. You could have said it in 2020. If this kept you out of the market, don't let it be your problem. And here's another thing. More recently, there was an interview on Bloomberg with Charlie Munger. For those of you not familiar with Charlie Munger, that's basically Warren Buffett's right-hand man. And in the interview, this is what he says. In 1999, Buffett said that the corporate profits are 6% of GDP in the US, and that is not sustainable. Guess what? Today, corporate profits are 10% of GDP. Buffett said that over the last decade, business has come back much stronger than he expected in terms of profits, but employment has lagged behind. So Munger's response to the relationship between GDP and corporate profits was, just because Warren thought of something 20 years ago, it does not become a law of nature. There is no natural correlation between GDP and corporate profits, folks. There's just not. Why? The SP 500 is not the economy. The economy is not the SP 500. As technology and innovation continue to evolve, businesses become more efficient and more profitable. That is different from gross domestic product activity or output. So, straight from the horse's mouth, folks. Don't be the person who falls prey to the whole Wilshire index, valuation versus the US GDP simply because Warren Buffett said something about it 20 years ago. All right, and P's are stretched, right? That's the other thing. Yeah, but what about the S&P 500 forward earnings P or the trailing P? This chart right here shows that the P/E ratios for the S&P 500 index have historically been higher when the US inflation rate is between 0 and 2%. Remember, in 2018, we were our forward PE multiple, our 12-month forward PE multiple hit 20 for the first time in like a decade or even more. In 2019, it got back there. In 2020, it got up to 22. Folks, where's the inflation? What is the Fed's inflation measure? Well, that's the PCE. That hasn't been able to stay at 2% for any more than like 3 months at a time from the last 11-year expansion cycle before falling over. We've been in this range of 0 to 2% on the PCE for more than, now 12 years. So according to history, it says we should have a higher PE. Should it be 22, 23, 24? Nobody knows. That's why using valuations as a means to allocate capital, it's a foolish game. You don't know when PEs are going to expand, how much they're going to expand, let alone whether they're going to contract or how much they're going to contract. Buy good stocks. Have a long-term time horizon. Stick to your game plan. Valuations, nonsense. Nonsense. They sound intelligent when the people come out on CNBC and they, run off all these numbers about the KP ratio and the S&P 500 forward 12-month ratio or the trailing PE ratio. It sounds all intelligent, but it's useless in real time. It's just useless. In hindsight, you may be able to see, I told you so. But again, we don't live in hindsight. We live in real time. We have to make decisions in real time. All right, last week, the VIX finally fell and closed below 20 for the first time in more than 6 months. So what does that mean for the S&P 500? What does it mean for the VIX? Well, let's take a look. And by the way, that was the second longest period that the VIX has stayed above 20 in history. The 246 days above 20 was the second longest streak above that level. The only other time was, of course, the 2008-2009 financial crisis. The table above summarizes the VIX closes on a yearly basis above the past 20 years. The VIX average close in 2020 was just above 29, which was the highest average since 2009. Let's see, 2009, the average was 31.48. The average for 2020 was 29.25. So far this year, it's 24.16 to date. All right, so the VIX closed above 20 86% of the days last year, which also is this, the highest since 2009. The S&P 500 after the VIX closes below 20, and I was expecting to see better returns, and that is not what I got when we ran the data. That is not what you get, folks. So here it is, S&P 500 after VIX closes below 20. This is basically, it has had to stay above 20 for 6 months. It's only happened 5 other times, so the data set is very small. Granted, it's very small. The results are rather mixed. The 2-week return in 1991, negligible. The 1-month return, down. Negligible after 3 months. 6 months, you had a better return. Let's go to 2009, seeing how that's the most recent example. The 2-week return, not bad, but gave it all back basically a month later. The 3-month return, not bad. You gave it all back 6 months later. So again, a little surprised that the data wasn't actually better. All right, the VIX. What about the VIX after its first close below 20 in 6 months? And again, we just have a sample size of 5. The 2-week return on the VIX, the average, it's actually higher. The VIX is actually higher. The 1 month, it's up almost 10%. 3 months later, 8%. 6 months later, still higher, 13%. So the whole thing about the VIX drop, and this is an average, and again, it's only 5. We have only 5 times where it stayed above 20 for more than 6 months. So again, I thought the data would be better, and it really wasn't. It really wasn't. But it does speak to what's happening this week with the VIX. We came into this week at 1997. It's 22, right? It's 22. So we'll see. We'll see what happens. All right. One of the things that we talked about last year that did not come to fruition was the cycles of fund flows. We had gone through 2 consecutive years of massive outflows in the market, 2018 and 2019. We had massive outflows. Usually the third year you get inflows. You get really strong inflows, but we know that was all upended by COVID. However, we are starting to see some significant inflows of late. This right here, this week's the Investment Company Institute, or ICI, reported a record 1-week inflows into equity mutual funds and equity ETFs. I mean, pretty awesome stuff, folks. 26 billion in equity mutual fund and equity ETF inflows this past week. And here's from Refinitiv Lipper, the second highest in 20 years, next to, 2014, which was a seasonal issue. So really strong inflows. Now, like I said, we talked about this last year with PhenomGroup.com members, identifying the trend in this table here from Morgan Stanley. And as you can see, when we have these strong outflow years, usually the third year, you have massive inflows. Outflow, outflow, massive inflow. Outflow, outflow. 2020 should have been massive inflows, but for the sake of COVID-19. Folks, I think we're going to make up for a lot of lost time there. And if you are thinking you need to get off this gravy boat of a market, the cyclical trends in fund flows suggest that you may want to stick around a bit longer. But where's the money not going? Well, It's not going to gold, and it sure as heck isn't going to bonds, right? We see bond yields moving higher. We see the relative performance of the S&P 500 to gold just rip into the upside ever since the bottom here in the S&P 500 back in March of 2020. It's been all about S&P 500. So investors are still hunting for yield, even though the 10-year Treasury yield has risen sharply through the Q4 2020 period and into this year. Although yields are rising, we don't think investors should fear rising yields, which are still at historically low levels, folks. We're not even at 1.5% on the 10-year. And yet the media just keeps marching out people saying, well, the market's going to, the whole paradigm's going to shift if yields keep rising. Look, yields are not going to keep rising. They rise for a certain period of time, and it doesn't really even affect the S&P 500 if you look out over the next 6-12 months, according to the historic data. Having said that, the market can have a hissy fit because of all the, well, it becomes a self-fulfilling prophecy. You hear this stuff enough in the media on CNBC. You see it so many times circulating in the perma-bear community on Twitter and Facebook. People just naturally gravitate to these kinds of thoughts and ideas that the market has to collapse because yields are rising, even though history says it's the exact opposite. Yields and the S&P 500 actually tend to rise together. Keeping in mind that the equity risk premium is still high at 3.24%. The equity risk premium says investors still need to be in equities. It has come down. Last quarter, it was at 3.81%. So it has come down as yields have risen, but it's still a very healthy level at 3.24%. And this chart right here speaks to rising yields being normal in the first year of a stock market recovery. And that's where we are, the first year of a stock market recovery. If we go back to 2009, right, the S&P 500 dropped 57% on an intraday basis. The 10-year yield bottomed at 2.86%. The 10-year, 1 year after that bottom, was at 3.7%. The change in the S&P 500 was still positive. Or I'm sorry, that was the change in the 10-year. But we know from history that the S&P 500 was still positive. I mean, it rallied from its March 2009 bottom all the way into 2010. It didn't have a material correction until, well, January of 2010. It dropped 8%, as yields were rising. Here's another chart, another piece of historic data. Quick jumps, because that's what we're talking about here. It's the rate of change in the 10-year that is catching people kind of off guard and, finding the media fascinated with the rise in the 10-year yield above 1%, above 1.2%, hit 1.33% just yesterday on the heels of some strong PPI data and retail sales data. And so it just gets people antsy that they just believe it's going to just keep going and keep going and keep going. So this study right here shows that, stocks do tend to freak out initially when you have such a big move. 10-year yield at the end of the month here, 2009, January 2009, at the end of the month, 2.84%. The change was 63 basis points. And the S&P 500 did have a bit of a hissy fit, dropped 8.6%. But 12 months later, it was up 30%, folks. The only time that the market had, these hissy fits, when rates were rising, they didn't have hissy fits. But 12 months later, because this was a time period where rates did keep rising and the absolute level was high. This was during a Fed rate hike regime as well. Is that the case today? No, of course not. The Fed has just told us Well, the Fed has been telling us time and time again, they have no plans. They're not thinking about raising rates for the foreseeable future. But again, all these different times, this right here, July 2003, the 10-year yield change was 0.89%. Over the course of a month, the SP 500 dropped 1.6%. It was up 11.3% 12 months later. So market, the market can have a hit. It can use this as an excuse. It can use rising yields as an excuse to consolidate price and find folks, taking some of this cash from off of the sidelines and bringing it into the market to continue the trend of dip buying activity. All right, fast forwarding kind of to looking at the economy and looking at fiscal policy. One of the things that we've been denoting in our weekly research reports to PhenomGroup.com members is that we're not going over a lot of the economic data that we usually do. We usually run the gamut of weekly economic data points, but because we've had such strong fiscal policy initiatives, not just here in the US, but around the world, it's just filling all the gaps. Outside of employment, it's filling all of the consumer-driven economic activity. People still have, checks or unemployment insurance, that they're receiving above and beyond, anything else that we've been able to give in history, and it's filling those gaps in consumer spending. So to the extent that we're also seeing this anomalistic data coming from the manufacturing sector, because it's a byproduct of the service sector still not being completely reopened. So it doesn't really make a lot of sense to dwell on the economic data. It makes sense just to know what's going on out there in the way of consumer spending, retail sales, housing, and all of those particular metrics. And it's great that we do have a manufacturing sector that can pick up the slack from the service sector, but don't really want to dwell on it so much because of the fiscal policies. And this was the chart from before January's fiscal policy package was instituted. And as you can see, we're the best. But here's the latest one now. In the past, GDP, fiscal stimulus as a percent of GDP was about 15%, just under 16%. Now, with the latest package, it's more than 25% of GDP. Why do you think we had such a strong monthly retail sales report for the month of January? Because in January, everybody got their checks, everybody got the additional unemployment insurance benefits, and now the savings rate goes higher, consumer spending goes higher, retail sales go higher. That's just where we are right now, with the potential for yet another fiscal package sometime possibly in March. And as it pertains to the Fed is still accommodative and has no plans of taking away the punch bowl too early. Jerome Powell has in no uncertain terms made it clear the Fed is not worried about inflation, and they are going to do what they can to achieve full employment. This is a statement from the most recent Fed minutes. They're not worried about inflation. They're mostly concerned with employment and getting people back to work. And that is also predicated upon how quickly we can get people vaccinated, get ourselves to a point of herd immunity, because the jobs are there. If you look at the JOLT survey, the jobs are there. It's a matter of we can't get the schools open until we get the the teachers vaccinated and get to herd immunity, so that people can go to work instead of being at home with their kids, because they've got to care for their children. So it's stuck between a rock and a hard place. But the good news is the doses per day, the vaccinations per day continues to climb. We are well ahead of the economist forecast. Basically at the beginning of the year, we're looking for 1 million vaccinations a day. We're above 1.5 million at this point, or as of yesterday's calculations, we're at almost 56 million people have at least had the first vaccination. We're ahead of schedule. We're actually the best in the world right now when it comes to the rollout of the vaccinations or the vaccine process. With all that being said, you know, when we look at all the consensus analyst estimates for global, US GDP, quite frankly, it seems too low. That's what this chart basically identifies. Most see a strong recovery in the second half of 2021, but the consensus feels a bit too cautious right now to us. According to Bloomberg, the consensus has Q1 GDP at just 3.3%. That's the bottom line right here. Yet, the Atlanta Fed is at about 4.5%, and the Federal Bank of New York is at 6.7%. With what we just saw out of retail sales and in industrial productivity, I'd be willing to believe that we're going to be somewhere between 5 and 7% in Q1 GDP. Folks, a lot of the estimates are too low. They're just too low. Why does the market keep trending higher? You think the market is oblivious to this? No, the market knows. The estimates have been wrong, whether it's GDP or earnings, since, basically the bottom in March. And I don't blame, analysts. I don't blame economists. Nobody has a model for what happens when you shut down the economy and then reopen it and then start rolling restrictions once again. Like, there's no model for that. So I don't blame the analyst or the economist for missing estimates, basically as a religion of late. And as we can see, these are the earnings estimates, and they keep climbing. Right here, full year 2020 consensus estimates are now at $140.62 a share. Last week, it was at $140.01. I don't want to, pat myself on the back or anything like that, but I've been calling for 140 for months now. That was my forecast. I said by the end of the year, we're probably going to have something like a 140 handle on earnings for 2020. Said that for months now. You could see it in the breath, in the trend of earnings results. You can feel it in retail sales and consumer spending data. That's the economy. That's where earnings come from, folks. And quite frankly, when you get all of this fiscal stimulus happening around the world, multinationals are going to have that stopgap where they can continue to see revenue growth coming from overseas. Last but not least, we've already started to see buyback announcements, folks. You really want to get off of this ride when we have earnings trending the way they are. We have fiscal stimulus being what it is, and another one possibly coming. I don't believe it's going to be 1.9 trillion, but still probably around $1 trillion. And now we have buybacks coming back. Remember, we had our lowest level of buybacks probably, in the last 7 years happen last year. And we had to know that as the economy came back and with all this fiscal stimulus and earnings, growing again in 2021, the buybacks were going to come along with that. A mere 5 weeks into 2021, the announced buybacks have already reached $145 billion. I'd be of the opinion we're going to get somewhere close to $600, maybe even $700 billion in announced buybacks before 2021 is complete. And that's all we got for this week, folks. Strong breath. If price consolidates, look at it as opportunity. We are still in the best 6-month period to own stocks, which will end in April. And that's not a sell signal. It's just to be aware of what the potential, returns will be like from the month of May going forward. So with that, thank you again for joining us at phenomgroup.com. This has been our weekly State of the Market.